Welcome, everybody, to Stock Dirty to Me, the beginner's podcast for investors. I am, of course, Phil Better, the host of this show, not an advisor, simply a host. We're going to bring in our first advisor here. As always, we have Dalt with us, an advisor at Banting Corp Capital, also an admin of the group. Dalt, thank you very much for showing up this week. You look amazing, enjoying the bright weather in Canada and relaxing. How are you doing this week?
Awesome. It's been a great start to the long weekend, and can't complain. Finally got some sun and some hot wet weather. It's been 30 degrees almost every day, so it's been awesome.
For our American friends, that's 30 degrees Celsius. And
Celsius,
you have to
so sorry.
double that and add like 35. I don't know. We don't understand your weird American math, but yeah, it's not. It's nice
something
weather.
over 80, between 80 and 85, probably.
Something like that. We're not meteorologists, we're stock people, so that's math we don't know. Bringing in our counterpart down in the States, we have Mr. Tony. Tony, how are you doing? How's the Stock Bros? Thank you very much for having your brother last week.
Yeah, no, I'm fantastic. No, he liked it a lot. He was a little thrown off because he didn't know what we were doing. So he's like, I'm not prepared at all for this. But yeah.
Generally, that's how we roll. We're usually 5 minutes ready and we just roll with what we have. But this week, we got a whole bunch of questions from the group. And again, if you're interested in asking questions during the show, make sure you hit that comment. Make sure you hit that like button so that we know you're enjoying the content. We always like hearing from you guys while we're doing the show and answering on the fly as best we can. Before we start, we're going to touch off crypto. It's been crazy. Who wants to touch on some of the craziness that's gone on this week?
Well, we could start by talking about China.
Yes, China had some big things in the news as well. So why don't you touch on that, Tony, for us?
Well, it's significant because for the first time, their state council and China's government cabinet members have actually agreed to restrict crypto mining and put more of a ban on financial transactions with altcoins and other various types of digital coins. I know they've already banned crypto from being used from financial transactions in 2019, but it sounds like they're coming down heavier on it now. And their reasoning for it is they're saying that they want to protect the integrity of their financial system, their stocks, their bonds, their other securities, and as well as meet their new clean energy and emission goals, which is a little suspicious for me. But I would say this article was very significant, or the news about this was very significant, because I was reading, and I think it was Market Watch, that China actually is the world's largest Bitcoin mining location. So they make up about 65% of the world's Bitcoin mining. So if they're going to start putting regulations on Bitcoin and start cracking down on that, that's going to significantly affect the price of Bitcoin, as we saw this past week. I think most crypto was down like 50% in a week.
Yeah.
So that's, I mean, they all move in correlation, it seemingly with each other for the most part. So, I mean, everything, if you owned a large crypto portfolio or had a large percentage of your portfolio in crypto, you got absolutely destroyed this week. And that's why we warned people not to do that and not to sell all your stocks and put all your money in crypto, because it's so volatile. 1 week you're up 20-30%, and then the next week you're down 50%.
Yeah, it's crypto, as fun as it looks and how much potential it does have. Right now, the market is so unregulated. It's not worth risking it. Put some dollars in it, of course, if you can afford it, but don't put all your money in it. Make it a small. We reiterate this every week. Put a bit of money in crypto. Don't put your whole. Don't yeet, as the kids say today, because apparently that's the word. I think yeet all your money in there and hope to God that it makes it, because that's not going to make you rich. Dalt, do you want to touch on the subject of China's ban and where crypto could or fall even more?
Yeah, so Tony touched on it pretty good. I could just add a little bit more to it, but everything he said is pretty much true. So China is ramping up, trying to fade out, I guess, sort of Bitcoin mining practices that they don't have control over. as well as starting to regulate some of the trading practices that are going on in the crypto space. So whether that be through additional taxes or just outright banning transactions in various altcoins, whatever that's going to look like, China is looking at it heavily. And the reason why it's having such a big impact is because, of course, China has 1.4 billion people. So you take 1.4 billion people at $20 a piece, you squeeze over $20 billion out of the crypto market. So that's why it's having such a big
effect
on markets. Also, again, with the carbon footprint piece that Tony touched on, this is the first poison dart thrown at Ethereum and Bitcoin. So these things are extremely pollutive. It costs an absolute fortune in electricity costs to send a Bitcoin transaction or Ethereum transaction. And the reason why I think they're going this route is they're going with Binance. So Binance obviously is the Chinese crypto exchange there. Everybody knows it. It's a very big crypto exchange. They have pretty much every altcoin you can think of. What's also interesting with that is what Binance did last year, which was the introduction of the Binance Smart Chain. The Binance Smart Chain is essentially a decentralized application platform, just like Ethereum, except for the fact that it's super green. It costs cents to transact, whereas it costs anywhere from $100 to $1,000 to transact on Ethereum. And it doesn't cost very much electricity to send BNB tokens across the Binance Smart Chain or associated BEP20 tokens. So this is a way that China is going to start to develop and push their own initiative for the Binance Smart Chain, because of course someone in China's state government sits on the board of directors of Binance.
Of course, that's how it works. China has their hands pretty much in all things. But I also heard recently that China's looking to create their own crypto yen, the Chinese yen going in crypto. Have you heard anything about that, you guys? And what do you guys think? Is that the future for fiat currency transforming into a cryptocurrency like this?
No, not really. Everybody seems to be saying they're going to have their own. If I had $1 every time some country said that and still didn't have one, I'd be very rich. Everybody says they're going to do it. Nobody's going to do it. I'll tell you why, because the dollar is already digital. If I told the last time I paid with cash was probably over a year ago. So you don't really use cash anymore. It's everything is tapped. I don't even need to really bring my cards because it's all on my phone. So you're not even using plastic now, pretty much.
All right, Tony, you did have a little. Seems that you were agreeing with Dalt. Do you want to add anything on that?
No, I agree 100%. I mean, the dollar's already digital. I know the U.S. Treasury was talking about we're going to make a digital dollar. The dollar's already digital. So what does that even mean? But I don't know. It just seems like they're trying to stifle cryptocurrency a little bit. They want to have a little bit more control. But I don't know. We'll see what happens.
All right. So that's our topics on our little warning about crypto. It's enter at your own risk, in essence. You'll see upswings and downswings worse than what you can see on the market when you're investing in proper stocks that we talk about here on the show, or we advise you in the group. One of the questions we did get regarding this was from Chrissy Dorse. I believe she was asking, what is a market order and a stop limit order? Now, Tony, do you want to handle this, or do you think we should hand it off to Dalt?
Well, a market order is just simply buying at the fastest transaction, buying it as fast as possible at whatever the market price is at that time. The danger with buying something through a market order, especially if you're going to be buying large quantities, if you're going to be buying 100 shares of something and you just set it as a market order, you could end up buying what you want for over $1 or $2, or even just a couple cents makes a difference when you're buying large quantities.
Yep.
And that's why I never use market orders if I'm going to buy anything in large quantities. If you're going to buy like a fractional share of like an ETF, like a VOO or SPY, like if you want to throw $25 into it, sometimes I'll just do that. I don't really care if it's a market order because I'm going to keep it for 20 years. But if you're going to buy 10 shares of Apple, I'm absolutely going to put in a limit order and not use a market order because I want to buy it for a very specific price. And the stop loss, was it stop loss? She said?
Stop limit order.
Stop limit order.
I think they may be.
I think she's just combining stop loss and a limit order, where stop loss is just setting it to a price you want to sell at in case it falls. So if you bought it at $10 and it goes to like 20, you might want to set a stop loss for like 15. So if it drops back down, you're preserving some of your gains. And then a limit order is just buying it at a specific price that you want to buy it at. So
okay. I'm going to bring in Dalt here just for now. Her second question was call put options, literally the act of buying and selling stocks. Is that what a call put option is, Dalt? Would you like to touch on that?
Yeah, just to add a point to Tony, he did get everything right with stop loss, limits, and market. There is also a stop limit order, and that's basically used to just buy in between basically a certain range. So say if SPY was trading at $400 per share, and you wanted to make sure that you could buy, if SPY were to reach 410, you'd be interested in buying at that point, but you wouldn't want to buy any more than say 415. So you'd set a stop limit order for say buy at 410, but no more than 415. So if all of your order can be had between 410 and 415, then it'll do a buy. And you could do it that the same way for stocks moving on their way down. Okay, it's just basically a combination of a stop loss and actual limit order. I've never used one though. Limit orders are good enough for me.
Yeah, I've never used one either. I didn't even know about that. That's interesting. Yeah.
Always learning on the podcast. That's what we're doing, and that's what we're here for, to educate you. So yes, going back to the original question, the call put options, are they literally the act of buying and selling stocks?
No, they have nothing to do with buying or selling stocks. They are, call and put options are basically a security, a type of security that gives you the right but not the obligation to buy or sell a certain amount of stock at a specified price. So the majority of call and put options are never exercised. They are traded back and forth. But say that again, I'll use SPY. You saw SPY at 400, and you kind of felt that SPY might rise to 450. So you'd buy a call option with say a strike price of 450, and you bought only one contract, so you have 100 shares. You have the right to buy 100 shares. What's really good about the options is that they provide you with a little bit of leverage. So obviously you would never be able to control 100 shares of SPY, or some people can, but most people can't. But that gives you the option to get leverage, and the amount of premium that you would have to put up to actually hold that would be considerably less than actually buying the shares. The good news is that should SPY rise from 400 to 450 and hit your strike price, your call option would start rising the closer it got to that strike price. And when it became in the money, it would rise even further. And so you'd be able to sell that option contract back to the market at a effective price to generate a bigger profit than you would have had if you just held the individual shares. So it's kind of a bet. It's a derivative. It's a bet that the stock will rise. If it's a call option or if it's a put option, it's a bet that the stock price will fall. You'll be able to buy it cheap and sell at the put option price. So they really have nothing to do with buying or selling stock. And another thing that's interesting is somebody mentioned that they bought a call option, and the security that the underlying call option was representing went up, and the call option didn't go up. So that can happen because still, in order for the call option to go up, somebody has to be bidding up that call option, that particular strike price at that particular expiration date. If there's nobody buying it and bidding it up, then your call option is not going to go up. Just because the underlying stock goes up doesn't mean your call option will go up. And if you're too close to the expiration date and there's a better chance that the market believes, hey, there's a better chance of this expiring than the stock going up. Even if that stock were to go up a little bit close to the expiration date, that call option might not move at all. So there's a little bit more finesse, market psychology, and all that stuff built into options. So it's it's a little bit more complicated than just buying and selling stocks.
Something more of a seasoned investor would probably be playing with versus the beginners that we normally talk to in our group, correct?
Yeah, well,
Absolutely.
you're just essentially you're just betting with calls and puts. You're just betting whether price is gonna rise or fall. So you're essentially gambling. That's basically what you're doing.
Okay. We're gonna have another question here from Chrissy, and then there's a question from the Facebook group that we're gonna answer. It's, let's say you already own VOO, right? And then you buy another ETF that has the same stock in it, like Apple, which is a popular stock in many ETFs. Would that affect you, and how would it affect you?
Was that for me?
Yeah, since you're on screen right now.
Look, when you're buying an ETF like VOO that has Apple in it already, the thing is, if you own Apple individually, you could get potentially a lot more gains from just holding that one stock rather than owning an ETF. So Apple did go up like 400% in the last 4 years, something like that. Don't quote me on that. I know it was a lot more than VOO. I believe it was like 400% in the last 4 years, and VOO went up about 100% in the last 4 years. So you are going to get 3 to 4 times more profits or capital appreciation with just Apple. But the thing about an ETF is you're also protecting yourself. If you make a mistake and you buy a horrible stock and that stock falls down dramatically, now it's not going to affect you as much if that stock is in an ETF, because it kind of balances it out. It'll balance itself out because you have Apple going up so much and that other stock you might have going down. So the ETF kind of helps you and diversifies your portfolio, and also protects you from making a really bad decision as well. You can own stock in Apple and ETFs that have Apple. There's so many ETFs that have Apple. I own Apple. I have 10 shares of Apple that I bought a while ago when they were really cheap. And I just think Apple's a great company. So for me, it's worth owning Apple and worth owning the ETF that has Apple in it. So you can do both. There's nothing wrong with doing both.
And having multiple ETFs that have Apple in it doesn't affect you. It just means you don't technically own that share. You just own the ETF, which owns the shares.
Well, you do own shares because you're owning that fund has a certain percentage of Apple shares. But if the thing is, if you're going to buy, I think the answer to this is don't buy a bunch of ETFs that do the same thing. You want to have different ETFs for different sectors, or you don't want to have SPY and VOO and SPLG and SPYG, all these ETFs that kind of do the same thing. You might want to buy an ETF for the S&P 500. You might want to buy an ETF for international stocks. You might want to buy one specifically for growth, for tracking the NASDAQ. You might want to buy one for REITs. Don't buy a bunch of ETFs that have all the same holdings. What's the point of that?
Excellent. All right. We have a question. I had to pull up it on my phone, but it's from Osman Isgari. Apologize, Osman, if I mispronounce your name. He's like, I have 22 invested in 10K power buying. Can I do day trading, or everything has to be invested? Now, this is something we see pop up, and in the questionnaire, we do ask you if you're a day trader like Gordon Gekko, or if you're more of a Warren Buffett type long-term investor. What do you say to this? He wants to know, can he do 10K day trading when he's invested with 22 already?
Sure, he can do whatever he wants. I don't know what what he means by investing and buying power. Is he saying he has 22,000 in? I'm assuming he's using Robinhood. So he has 22,000 invested into stocks or whatever securities, and then he's got 10,000 separate in buying power. Is that what he's saying?
We would have to know, Usman, if you're still watching, if you could just clarify that for us so that we can know specifically. Is that what Tony just mentioned?
I'm wondering if he's talking about the pattern day trading rule. If he's wondering if that will affect that, I think he needs to have 25,000 total to where the pattern day trader rule doesn't apply for Robinhood. So it sounds like he has 32,000, so he's fine. I would just say if he's going to start day trading, you should probably be really careful and really study and analyze what you're doing first. So,
excellent. Dalt, do you concur with him? You have anything else to add for our member who looks to be jumping into day trading, possibly?
That was perfect. What Tony said, just make sure. It's a day trading is a different monster because you're mostly speculating and you're trying to take advantage of smaller moves, and in order for that to be profitable, you either have to get leverage somewhat or weigh in with a lot more money than you otherwise would. So just make sure that
you take your time.
You speculate. I'm trying to figure out the right word to say, but there is none. Just
don't start out with
be
$10,000.
as careful as possible.
Don't use your $10,000 for day trading. Why don't you start out with like a couple $100 and play around with it for a while?
Yeah.
Smart advice from the advisors and the admins here. We're going to go into a question that Michael Santos had in the group. And again, if you want to have some questions like Usman, just ask them in the chat. We'll be more than happy to provide them. Hey there, user Michael Rowe. Nope. Is that Michael?
Michael Rowe.
Michael Rowe is asking, actually, Michael Rowe, it hasn't, there it is. Michael Rowe, here it is. Is there an indicator that y'all prefer?
An indicator for trading?
I'm guessing that's what he means, or maybe an indicator, maybe a stock indicator. I don't really know. When you guys ask your questions, make sure you fill out the questions in fully so that we can answer them.
Technical analysis, probably.
He's probably talking about technical analysis and how to.
Well, that's great because our next question from Michael actually deals with that. So we'll go into that. Do you guys use discounted cash flow analysis, or do you use technical analysis? And what are your thoughts on those?
I use the balance sheet analysis where I pull up all of the earnings reports, especially the last quarter and the current quarter or the most recent. And I'll look and see, I'll check for the earnings per share. I'll look for cash flow. I'll see if they have positive cash flow. I like investing in companies that have positive free cash flow, meaning that after they pay all of their business expenditures, they have money left over, because then they can reinvest that money back into the company. And also, if there's a pandemic, they have cash on hand in case their sales go down. I also like investing in companies that have low debt, less than a 1 ratio. I like investing in companies that have actual profits and their profits are growing over time, or at least, staying steady. You can't always beat profits every single quarter, but company that has solid growth potential. And I just look for stuff like that. I look at the PE ratio. I'll look at the price to book value, which is a big one for me. I don't want to buy a company that their share price is way overvalued or bloated compared to their actual book value, meaning like the value of all their assets and how much cash they have on hand. So that's the stuff I look at. I don't really know. I'll be completely honest. I don't know a lot about reading candlestick charts or anything like that because I don't do a lot of that stuff. I know that Dalton would probably be good to answer that question. So,
and on that note, let's bring Dalton on here, our resident advisor at Bantingcourt Capital, an amazing website, an amazing advisor himself with a great blog that can teach you a lot. So yeah, we're going to jump into a more detailed question: the discounted cash flow analysis or technical analysis. What do you use to measure stocks before you buy?
So definitely not discounted cash flow. I did one of those by hand for a member of the group probably a month and a half. It was just a pain in the ass. I just hate it. And you have to make a lot of assumptions to speculate on that figure. And so depending on if you change one assumption or you're 10% off here, 10% off this assumption, 10% off this assumption, you're going to have wildly different results for what that true, intrinsic value price is if you're using discounted cash flow. So I don't use it. I have my own theories, playbook, I guess you could say, philosophy for in investing. Most of it I put in that how to research article. That's typically how I invest. Technicals, I don't really look at them at all. The reason being is because what tends to happen is it's the easiest thing to actually look at and to actually learn to do. And all it really shows you is what everybody has done. It doesn't show you what people are doing right now, this second. It shows you what people are doing 1 minute ago. That's like as far back as you can go, or 30 seconds or whatever. And it doesn't predict the future. So one way to look at this, if everybody in the market is wrong, everything you're seeing on that chart is also wrong. So 2008, when they said the stock market was, all those indicators for technical analysis in 2008 were bullish. Every single one of them were bullish. Not one of them saw anything because the majority of the market is dumb. And so your technical analysis are going to be dumb. You had to actually do it the Michael Burry way and look through all those mortgage bonds piece by piece, go through hundreds of thousands, millions of people's mortgages in the United States to see that there was a problem. That was the hard way to do it. But there's a reason why he was the only one doing it. And that's the reason why it didn't show up in the charts when he started to short the market, because nobody else was doing it in the market. So the technical just stayed bullish. So that tends to happen. So like sometimes I'll get into a stock and everything is negative. The technicals are negative. And I'll go and I'll buy it because the fundamentals are strong and the stock will go on a huge run. And then all of a sudden, all the technicals are showing bullish. Everything is bullish now. So it's very hard to say. I developed my own trading algorithm. I spent quite a pretty penny on it. But just to make a point, when I spent the money to go make my own and have a partner that I did this with, we don't use any of the indicators that everybody in the market uses. There's no candlesticks there. There's no Bollinger Bands. There's no parabolic star, which are probably your big three. There's no moving averages. So you have to find innovative ways if you want to make technical analysis an actual trading strategy for you.
Excellent. So yeah, we're coming up to near the end of it. We're gonna finalize on one question. I know that either Tony or Johnny, the other admins, did answer this question in the thread, but I wanted to bring it on because it's something that's important. It's from Aaron Snoke. Sorry. He was wondering if he held some, say half of a losing stock, and I buy and sell the other half during the dip and rises. And if I still lose money, would I be able to claim the losses, or would the 30-day wash rule apply? So I'm going to try and simplify it. He bought a couple stocks that start losing. He sold half, kept the remaining half just in case it would grow up. And he sold it during the dips and the rises, I guess, and he still lost money. Would he be able to claim those losses for the 30-day wash rule?
Tony, do you want to take that one? That 30-day wash rule is I don't think we have that. Every time I hear that, I'm like, what the hell?
All right, we'll bring Tony here.
I think if you sell a stock, so if you're losing money and you sell a stock and then you buy it back within 30 days, the wash rule applies and you can't claim it, regardless of what happens. So you want to wait that 30-day period. If you're going to claim a large loss on a stock, you're going to want to wait 30 days before you buy it again, just in case. So I believe it still applies.
If you suffer a 10% loss and you sell out and then you buy back in
within 30 days,
you can't claim that loss within 30 days. Oh.
If you buy back in within 30 days, you can't claim the loss. Because it's some rule they put in because I guess a lot of big hedge funds or somebody was doing it and taking advantage of the rule somehow. Someone was misusing it or taking advantage of it. So they put that rule in place so that you can't do that. So I don't really know the origins of it. That would be a good one to look up to find out. It might be a good episode idea, actually, because I don't know a whole lot about the origins of that. But yeah, if there's not really a way around that, if you sell, it's always best. I think if you want to claim losses, it's always best to try to do that at the end of the year, right around the time you're going to do your taxes. So just sell it, take your losses, and then you can claim up to $3,000 for the following year. But the other important thing that people don't realize, I just have to say this, is you can write off up to $3,000 of losses, but that's not a write-off, and that doesn't mean you're getting back $3,000, everybody. It means that it lowers your taxable income by $3,000. So you're only going to get a very small percentage of that. Maybe you might get nothing back, depending on what your income is. You're only going to get a very small percentage back of what you lost. You're not getting, the government's not going to just say, oh, you lost $3,000. Don't worry about it. Here's $3,000 back the next year. They're never going to do that. Never.
The government doesn't want to give you money unless it's a pandemic.
Money because you made a bad decision on a stock. They're never going to do that. So just remember, it's a write-off for your income to lower your taxable income. It's not a write-off that you're going to get $3,000 back. So.
Excellent. So, Tony, we're going to round out the show. We're going to let you start. Where can they find you? How can they follow so that they can learn more from you?
So we got the Stock Bros Podcast. We'll put the link in the comment section of this video. And my brother and I just filmed a video together earlier today about the S&P 500 and the origins of it. So he's back, and that one will be out in a few days. So.
Excellent. Thank you again, Tony. Make sure you check out his podcast, The Stock Bros. It's great, and he's always in the group chatting. So he'll be putting the link to his podcast and his YouTube channel in the show notes down below. So we're going to say goodbye to Tony. Goodbye, Tony. Now we got Dalt. What? Wrong one. There we go, Dalt. Dalt, where can we find you? How can we learn more from you? Let our audience know.
Yeah, as always, I'm there in the group. Always tag me if you have a question on a certain post, or if someone posts something in the group that sounds ridiculous and not related to securities at all. Tag me, and I'll be sure to clear it up. But I'm always posting all of my blog articles in the group. You can find my blog at bantingcourtcapital.com/blog. I actually wrote another blog article today and posted it in the group on how to recover from losses in the market. So I do articles every Sunday and Wednesday. And on Instagram as well, every Saturday, I do a live video of my own. I just talk about things that happen in the market. I talked about the crypto crash yesterday, and then I post a whole bunch of content throughout the week that has to do with investing and startup business, all that sort of good stuff. So you can always find me either in the group or on Instagram, and my Instagram handle is @RismayLife. So RISMAY, my last name, and then life.
Excellent. Thank you again, Dalt. Have a good night, and we'll see you in the group.
You as well. Take care, man.
Thank you. I am, of course, Phil Better, but before we jump into my spiel, I want to say the other panelist is Johnny, the CEO of this organization. The reason we are here learning about the stock market, he helped grow this from 0 to the large number we have now and asked me to do this thing. So go over to wisemantraders.org, sign up to his newsletter. It's an amazing newsletter for knowledge on investing. Make sure you check out Johnny's newsletter and his blogs and his ability there. I am, of course, Phil Better. I host the podcast Invest in Yourself, the Digital Entrepreneur Podcast, where I talk with entrepreneurs, business owners, and influencers on how they got their journey started, how they created the side hustle. And of course, I do talk with investors as well, because they are important to growing your money and learning about it. So make sure you go over to investingyourselfpod.com and listen in to some of the great episodes we have rolling out season 3 next month. It's going to be fantastic. And I have some amazing millionaire guests on and people who have exited out of their businesses. So that's something you really need to check out. So it's investingyourselfpod.com. You can find me at Podcaster Phil Better on Instagram. And of course, in the group, I want to thank everybody here because you guys are amazing. We only do this because you guys have asked for more knowledge. And I wish you all a great day.